$1 million residential house versus $1 million commercial property warehouse. Which one is best for you in terms of cash flow, growth, and what does that look like for you 2 years, 3 years into the future? And is it going to help you to build more wealth, more cash flow, more growth to allow you to get to financial freedom faster? Which one should you choose? This video is about working through the numbers, the examples of what you can get right now in this market for $1 million. A warehouse space is one of the most popular investments right now in commercial property, or a house for growth reasons. Which one should you choose right now? If you can buy another property, if you can go right now and buy another $1 million property because you have somewhere between $200,000 to $400,000 in a deposit, this is your choice. And this video, I'm going to share with you the numbers, what kind of properties you can get, and what kind of returns you can get in both cash flow and growth, and what does that look like 2 years from now. My name is Helen Tarrant. I help everyday Australians become wealthy through property investment, teaching them about how to create passive income, multiple streams of income, how to structure their deals, build out strategies so they can get to financial freedom faster. And predominantly been helping everyday Australians build that out through commercial property, but I really want you to go in there eyes wide open so you know what you can get right now in this market for $1 million. So let's have a look at the numbers. Right now, if you want to buy $1 million property that's residential, you can buy a house in the fringe suburbs of Melbourne, or a house in Brisbane about 17 to 20 kilometers out of Brisbane CBD. Now that house is probably not going to be a brand new build. It's going to be an older style house, maybe built in the 50s or 80s. It's going to be a large enough house on a good enough block, maybe about 600 square meters a block with 3 or 4 bedrooms. So it's quite a nice house, older style, maybe a Queenslander. It's about $1 million. Now the rent you're going to get on that property is about $700 per week. Now that equates to somewhere around $36,000 to $37,000 per year in rental income. Now remember, in residential property, that income coming in is all the income you're going to get for this property. So the tenant gives you one lump sum, and from there you have to take out all of your expenses plus mortgage on top of that. So let's have a look at what the expenses look like, right? So let's say you're buying this house here in Zellmere in Brisbane. Now this house in Zellmere in Brisbane is a nice Queenslander, nicely renovated, some original conditions, but good layout, good solid house. You could have a really nice lifestyle, relaxing lifestyle. It's about $1 million. The rent on it is about $700. When we look at the outgoings of these property to maintain this property, you're looking at about $1,700 in terms of rates. So that's your council rates and your water rates. Probably about $2,000 in terms of insurance on that property. You may or may not need to pay for land tax. Let's say for this example, we're not paying land tax because it's under the $350,000 threshold, or your personal threshold of $600,000 if you're buying in your personal name. So let's just say it's under the threshold. But you'll have to pay management fees if the property is rented out. Typically, management fees in residential is going to be somewhere between 6 to 7% right now plus GST. So that's going to come in a bit over $2,000, but let's just say call it $2,000 roughly in total, right? Plus, you probably have a little bit of maintenance here and there over the year, maybe somewhere between $500 to $1,000. So all up, you probably have somewhere around that $6,000, maybe even $7,000 in terms of outgoings that you have to pay to support the property. Remember, you're getting about $36,000 to $37,000 in rent coming through. So after outgoings, you're going to have about $30,000 in rent coming through. And that's what we call net rent, right? After outgoings, before mortgage, that's your net rent coming through. Now from there, you have to pay the mortgage. But if you're buying a $1 million property, you need to get a loan, right? It's not going to be all cash. So typically, most people get an $800,000 loan against their $1 million property. So 80% loan to valuation ratio, so $800,000. And right now, the interest rate sits around that 6.5%, maybe a little bit higher, maybe a little bit lower, depending on your servicing and your ability to borrow. But let's call it 6.5%. Now that equates to somewhere around $54,000 on $800,000. Now, remember, you only have $30,000 left from after the expenses of this property to pay the mortgage. Now, if you're only getting $30,000 back, but your mortgage is $54,000, how much do you have left, or are you in negative? Well, the answer is you're in negative about $24,000. So You have to find $24,000 out of your own pockets because no tenants are not going to give it to you. So that equivalently costs you somewhere between $400 to $500 per week that's coming out of your own pockets. Now, the average Australian wage is somewhere around $80,000, and a good wage is somewhere around that $100,000, maybe $110,000. Now, after taxes, you're probably getting somewhere in your pocket between $1,200 to about maybe $1,500, $1,600 per week. Now, if you have to, out of your own wage, come up with $400 to $500, that's almost 30 to 40% of your wage going to supporting one property. Now, if you're taking out 30 to 40% of your wage to support one property, how are you going to move forward when you are spending 30 to 40% of your average wage to actually support this property? Plus, on top of that, don't forget you have to live, you have to go and pay school fees if you've got kids, holidays, all of the things, travel expenses, just your mobile, all of the stuff that you have. You're really struggling to support that one property plus your own lifestyle. So that's why most Australians don't get past one investment property, because it just simply costs them a lot to invest. Now, let's say instead of using that $200,000 and buying a $1 million residential property, you buy a $1 million commercial property, a little warehouse somewhere in Brisbane. It could be 30 k's out of the Brisbane CBD heading towards the Gold Coast. It could be 20 k's going up towards the Sunshine Coast. It could be somewhere between that 20 to 30 k mark out of Brisbane CBD. So it's still Brisbane Metro, and it's still an area that's really well gentrified or developed. It's probably going to be in an industrial hub. It's not going to be a freestanding property. It's going to be part of a strata, so it's going to be part of a business park. So this property here is in Crestmead. It is a property that is $1 million in terms of the purchase price of that. It's a little tilt, what we call a tilt slab commercial property. Now, this tilt slab commercial property gets a return somewhere around that 5.75 to 6% yield. Now, that's because it's a little bit further out from that CBD. If it's closer to the CBD, you're going to get much lower yields, maybe around that 5.5 to 5.7. Now, being a little bit further out, you're going to get a little bit higher in return. Now, when I talk about yields in commercial property, it's the cash return on the purchase price. So let's say that the property yields $60,000 in net rent. It's a 6% yield against $1 million. So, for example, the tenant's paying you $60,000 in net rent. It is a 6% yield against the purchase price or the sale price if the sale price is $1 million. So that's the yield. When I use yield, that's what I mean. Now, one key thing in commercial property that's different from residential property is that it's a net rent versus a gross rent. So remember how in residential property, when the tenant pays you, it's one lump sum and all the expenses come out of it. In commercial, it's different. When the tenant pays you, that's just the rent. They pay the outgoings on top of that. So if you think back to your residential property, how that $700, out of that $700 a week and $36,000 a year, you're paying $6,000, right? Equivalent to about $120 a week out of your $700. That works out to be almost 20%. So in fact, in residential, there's almost 20% of your income being paid out to outgoings. Whereas in commercial, your tenant actually pays that extra 20% on top of the rents they give you. Plus, one big thing is they pay higher rents compared to residential property. So $1 million commercial property right now, a little warehouse in Brisbane, when we're comparing apples with apples, is actually giving you a higher return in terms of rental income than your residential property. So it's going to give you a $60,000 when the tenant pays you. Instead of them paying you $700 a week, they're actually paying you about $1,200 a week. They're actually paying you 50 to 60% more than you would get in your residential property. So in commercial, the same purchase price, you're actually getting 50 to 60% more rent coming in than your residential property. However, on top of that, your tenants also pay the outgoing. So they're paying the additional 20% on top of what they're paying you in rent. So instead of you taking that 20% out of the rent that they pay you, that's actually coming on top of what the tenant pays you. So in actual fact, what goes into your pocket is so much more. So this little warehouse is amongst a couple of other warehouses, about 20 or so in the complex. Now, this warehouse is your typical tilt slab warehouse that developers develop, and what goes in there is typically your e-commerce service trade type of business. So they might have an online store and they do distribution, so they have a warehouse space plus an office space. They might do flooring, they might do trades, it might be a plumber or electrician. Like, it opens itself to multiple types of tenants. The tenants can have a showroom where people come there to pick up goods, to see goods, or they be direct to the public in terms of delivery, right? So what you essentially get is this versatile property, and you typically has a mezzanine floor. It's typically around that 250 square meters in size, right? And this type of property is located all around Australia, but because we're comparing Brisbane properties, I wanted to share with you 2 Brisbane properties to compare. Now let's explore that $60,000 coming in from your commercial property versus the $30,000 coming in from your residential property. Now remember, to service the debt on $1 million property is the same in residential as it is in commercial. So that same $800K has the same interest rate of 6.5% in commercial as it is in residential, and the same repayments need to be given to the bank regardless of whether you have residential or commercial. So the same repayments is $54,000 a year. Now, in residential, you're getting $30,000, but you have to pay out $54,000 so that you're negative $24,000. In commercial, you're getting $60,000, but you need to only pay out $54,000. So you're getting $6,000 back, which means that if you're on an average income and you're only getting $1,200 to $1,500 a week in your pocket, getting an extra $100 a week back from the actual tenant after the mortgage and outgoings being paid, that extra $100 works out to be somewhere between 7 to 9% of your income every week coming into your pocket. So you're getting an additional 7 to 9% additional, just call it like almost like a pay rise coming into your bank account, subsidizing your lifestyle. So right now, if you're looking at residential versus commercial, one is going to require you to take out 30 to 40% of your income to service it, to pay and support it. The other one is giving you 7 to 9% back in income, right? So you got to work out which one is better for you now, especially with the interest rate where it is. However, the question that most people ask me is, what about capital gains? Don't you get more capital gains from residential than you have from commercial? So isn't it better for me to just invest in residential? Even though I'm making a loss at the front end, I'm going to pick it up on the back end. Now, let's truly explore that, because it's a huge myth out there that there isn't capital growth in commercial property. Because one of the things that do happen in commercial property is that there is capital growth, and capital growth happens as an area gentrifies. So remember, you got lots of house and land packages out there getting developed, they're just getting infinitely built, right? And all of a sudden you might get 300 or 400 houses. Now these people are going to demand childcare centers, medical centers, a little area to do shopping, cafes, hairdresser, dentists, and so on and so forth, right? So then a little commercial hub pops up, and you'll find that instead of having 300 commercial properties, out of the 300 houses, there might only be demand for, say, 20 shops, right? So the commercial properties are actually extremely resilient to market forces. They actually retain their value and continue to grow in value more than residential property, because there's limited stock, but a lot of demand, because people are seeing that all the people in the area are accessing those services. There's very little vacancy, so rents continue to go up, therefore the value continue to grow up, and there's just not enough stock there for people to buy and trade. So it continues to keep the prices going up. One prime example is this property that we helped our client buy, which is a property on the Sunshine Coast in 2020. We got him in 2020, just as the COVID was hitting. It was at March when he settled on this property, and it was yielding him 7.5% at that time. But he bought this property for $900,000, right? Now, fast forward that to this year, 4 years later, that property is worth $1.25 million. He's refinanced against it, pulled out the equity, and go again, right? But that's a 40% growth over that time. 40% over 4 years, so 10% growth each year. Plus, remember 2020, interest rates were going down to its lowest point around that 3% mark. Now, he was picking up somewhere around $30,000 in positive cash flow from that one deal. Now, as the interest rate went up, he would have picked up less cash flow, but he would have still been positive. And even right now, the highest interest rate, he still would be clearing somewhere around that $8,000 to $10,000 in positive cash flow while picking up on the growth. So you can see that in commercial property, you can have your cake and eat it too, right? And if you choose the right property in the right area with the right strategy, you can absolutely benefit from both the cash flow and the growth. And remember, it's taking the pressure off you to support it. So let's have a look what happens in 2 years' time if you decide to buy residential, that $1 million residential property versus that $1 million commercial property. Now, we all know when we first start out with the commercial property, because the tenant's giving you $60,000 in net rent and you're only paying out $54,000, you're going to be $6,000 positive. And the residential, you're going to be about $24,000 negative, right? Purely because how much your tenant's paying you in rent. Now, let's fast forward this in 2 years' time. So 24 months, right? Let's say currently the interest rate is 6.75. Remember, the Feds have cut the interest rate now by 0.5%, prompting pressure on our RBA to actually drop rates. And people are predicting that there's going to be a 4 interest rate cuts before the end of the year next year. So we'll bring that down by 1%. Now, let's just say that didn't happen over 12 months, but happened over 24 months, right? Let's be really, really conservative and say it happened over 24 months rather than 12 months. So we're now the interest rate's at 5.75%. Now 5.75, the current interest rate, let's look at a couple of things. Firstly, we know that that rent was sitting at about $36,000 originally, and we're taking out $6,000 of out, being $30,000. Now, let's say that each year they did end up putting up rent, but probably maybe only like about $50 a week. So that works about maybe $2,500 a year times 2. That's going to be about, so we say we add in 2 years of rental increases. So 2,500 plus 2,500, we're now at $35,000, right? We're at $35,000. Let's say that the outgoing stayed the same. We're at $35,000 for residential property. Now that's your current rent. Now let's go and look at commercial. Now, if we're looking at commercial property here, now we know that the property started out at $60,000. Now each year, typically there's about, especially in Queensland, the increases average out to about 3.5% per year. So let's have a look how much that works out to be per year on that $6,000. So it's times 1.35, right? Which is at $3,500, which is at $60,000. Now 1.035 works out to be about 2,100. And remember that compounds itself. So the first year you end up with 62,100, and you times that by 1.035, 35 being 3.5%. The next year it becomes $64,730, right? That's how much the rent is after 2 years, right? Now, at 5.75, we're going to work out what the interest is on the 800K. So 5.75%. So let's work that out. 5.75% on 800K is equal to, now that it works out to be about $46,000. $46,000, okay? So what does that actually mean? So now, instead of paying $54,000, you're paying $46,000. So you're paying less, right? However, one of the big things that most people don't realize is that they're still only getting $35,000. Remember, you're still getting $35,000 from your residential property even after 2 years of increases on the rent. But you still owe the bank $46,000. So what do you have to do? There is a shortfall of $11,000. There's still a shortfall of $11,000. Now, in commercial, we have $64,000. $46,000 is what you owe the bank. How much do we have left? We've got almost $18,000. We've got almost, so you end up with $18,743. So in commercial, remember you're getting now $64,730. You owe the bank $46,000. You're actually getting $18,743 more. You're actually getting $18,433. So it's actually more than what you got when you first started investing in commercial property. Now, if you added the growth to it, so for example, let's have a look. Say in residential, most people, if you were paying $24,000 in negative, now most people are looking for somewhere around a 7 to 10% increase, 7 to 10% capital growth, right? Let's even say at 10%, right? It means that you're losing initially, when you're $24,000 negative, you're losing 2.5% in terms of your cash flow, right? In order to gain the 10% at the back end. So your true return is somewhere around that 7.6% in overall return. Now, if you look at that and say, well, on $1 million property, over 2 years, that property is going to be worth $1.2 million, right? It's going to be worth $1.2 million because it's gone up. Yes, it would have cost me those years about $50,000 to support it, maybe give or take $5 grand. It's going to take me that, but I've gained 200 grand in the back end. However, if you got a commercial property and it was giving you, let's say, not the same returns as 10%, but in actual fact, it probably will. It was giving you a 7% in terms of capital growth on that $1 million over 2 years. That property will be worth $1.14 million, right? So 70,000 plus another 70,000, 140,000, 1.14 million will be what it's worth, right? So you've got residential worth 1.2 million that you have to be negative $50,000 for. Then you've got commercial, which maybe not have the same, let's just assume, in actual fact, they actually have the same growth rate, but let's just assume for this argument's sake that they don't. Then they go to 1.14 million, so only a 7% growth. However, just look at how much you're gaining on the front end, right? Each year, firstly, doesn't require you to service the property. Secondly, it's going to put money back into your pockets. If in 2 years' time, you're still earning 100 grand or 120 grand, $18,000 is equivalent to 18% increase in your income coming into your pockets, right? Yes. So what does that mean? It actually means that you actually end up with more money, less headaches, less stress, as they're not requiring you to service the property. That 18,000 ends up being about 1.8%. So if you add the 1.8% to the 7%, you actually end up with about 8.8% return overall in the commercial property versus about a 7.6% in residential. Overall, commercial property is a much better buy right now. If you had the same $1 million with $200,000 to $400,000 in deposit, right now, commercial property is a better buy for you as the next investment versus residential because firstly, you're not negative. Secondly, there's money coming into your pocket as if it's like an increase on your wages, especially with wages stagnant. It's an increase on your wages. Thirdly, it increases in capital growth as the back end as well. Plus, when the interest rate drops, it's going to give you more cash in your pocket. So right now, the smart decision for you to make is actually go commercial rather than residential on the same property with the same price point. My name is Helen Tarrant. I help everyday Australians become wealthy through property investment, teaching them how to get passive income, multiple streams of income, how to structure their deals and portfolio so they can get to financial freedom faster. If you like this video, loved it, make sure you share it, make sure you comment below what else you want, hit the subscribe button, and I'll see you in the next video. Bye for now.